Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Hello, everybody. Welcome back to another episode of Blind Spots. We are doing a follow-up episode to one of the previous podcasts that we did called How to Break the Stockbroker Mindset. So this is part 2. So if you haven't listened to part 1, head over there to know a little bit more about what we are talking about today. But we are focusing on our process for new clients and how we help them on the behavioral side in breaking the stockbroker mindset.
So in order to get a good investment outcome, you have to know who you're dealing with. And every client is different. Sure, we have an investment process. We have a framework for making decisions. We'll touch on that. But in order to reach someone, to communicate and to convey how you're going to approach the investments and what you're going to do and what would trigger a buy and what would trigger a sell, and understanding how they could react if markets go down, we've developed a series of questions that better help us understand. Because when you get to know somebody, like you really get to know someone during a difficult period. So adversity tends to bring out who that person really is. And everyone's a happy investor. Everyone's easygoing when times are good and people are making money. When the cycle turns, which it inevitably will and does, that's who you are as an investor. That's what we're trying to get to and understand before something happens.
So we're going to first just quickly walk through what our onboarding process looks like and where this fits in, because we like to do it at the beginning of a relationship with a new client. So we often talk about how many of our clients come from other advisors for a variety of reasons. And oftentimes we find the stockbroker mindset is ingrained in those clients that come from large Wall Street firms, big banks, things like that.
Just pause there. So the stockbroker mindset, the Wall Street mindset, is heavy in human intuition. It's heavy in reactionary activity, making off the whim decisions based on the daily news cycle or maybe a narrative. Like there's several firms out there that have been really bearish. So coming into 2023, this was the first year that the consensus, so conglomerate of Wall Street banks, like 25 of them, predicted the market to go down. That has never happened in my career. Usually they err on the side of the market going up. So what I'm saying is it's very much fly by the seat of your pants, overweighting what just happened, making emotional reactionary investment decisions. That's what we mean by the broker or Wall Street mindset. They typically get paid when you do something. And so they often lead with complexity, you doing something, making changes, because that in their mind is a value add. And through your eyes, you would see them as a necessary cog in your financial plan or your investment portfolio.
Yeah, so when a client comes on board at Pure Portfolios, of course, we have all of the paperwork. We try to do everything as quickly and efficiently as possible, but we will open up their accounts, bring the assets over, and we start off typically with a risk questionnaire, as many other firms do. But Nick, tell us why ours is special or different.
Yeah, so before I share my screen and show you how we frame that conversation, there's a softer side. Sure, there's the numbers and there's unpacking the way that you feel about risk, but there's several questions that we've gravitated to as we've evolved in this process. And the first question I always ask people is, how have you behaved in the past? And I'll usually bring up the spring of 2020, which was the COVID sell-off, or 2022, which the entire year was very difficult, and get them to talk about how they reacted, any changes that was off script, or any emotional decisions that they may or may not have made. I also want to understand, and this catches people off guard, where they get their news, where they get their information from. And it's very interesting. It's usually a combination of a circle of friends or family, social media, and one or two sites or TV channels or news outlets that they watch. And then the last question is, what personal experiences have shaped the way that you view money? It might be a grandparent that lived through the Great Depression and was a hoarder and was very frugal or intentional about the way they spent their money. It might have been a parent who was very spendthrift that didn't have a problem with spending money. It might be an attitude towards debt. Some people shun it, some people embrace it. Really depends on the type of household that you grew up in or any personal experiences that you may have had that had a huge impact on the way that you view money. And from that, I can get a sense of the softer side of someone's attitude towards risk and reward and weighing that equation. Okay, so once I have an understanding of their personal experiences and the way that they view money, we go through an exercise. And I've wrote blogs in the past poking holes in the way most advisors capture their clients' attitude towards risk. And you all have probably done one of these in some capacity where they say the market dropped by 20%. Would you A, buy more, B, do nothing, C, sell? And most people know what they should say. So they put A, I would buy more. But there's one thing that these questionnaires do a very poor job at, and it's almost impossible to recreate the fear and panic that go along with the market sell-off. But they can't recreate that. So people end up answering based on what they should do. Most people know what they should do. So again, it's hard to know how someone's going to react until you get that actual market event. And I equate investing with the old pilot's quip. Investing is like flying. It's hours and hours of sheer boredom punctuated by moments of sheer terror. And you can't create the sheer terror through a boring questionnaire. So what I feel our exercise does is it really helps put tangible value to risk. We all know what risk is. Sometimes it can be tough to understand in the context of an investment portfolio. So we ask people to tell us their acceptable range of investment outcomes in both dollars and percent. And for those of you listening, you cannot see my screen, but I'm going to share my screen and I will try to explain everything like you cannot see my screen.
For those of you listening on the podcast, if you want to see a visual, jump on over to our YouTube channel, but we'll talk through it and give you the idea as much as we can.
So this is the output from our questionnaire, and this is my dog, Bush, who has been featured on blogs and videos in the past. And basically, we take people through a series of questions that frames risk in both dollars and percent. So let's say you have $1 million invested. I know it says 1.3 on here, but I'm going to say $1 million. And it'll give you two different scenarios. One might say, for your $1 million invested, you might have an opportunity to lose 5% or gain 8%, okay? In the other scenario, it might tell you, you have an opportunity to lose 8%, so a little more intense on the downside, but gain 14%. Which one would you choose? Okay, and it takes you through 3 different iterations of that, and it frames it slightly differently each time, all right? What's important about this is it shows you the choices in both percent. So like I said, minus 5% or plus 8% or minus 8% and plus 14%, but it also does it in dollar figures. So under the 5%, it'll say negative 50,000, assuming we have $1 million invested, or plus 80,000, assuming we have $1 million invested. People understand dollars. Percent might gloss over. Percent can be confusing because it changes, like the dollar amount changes with the money invested. But when you add the dollar amount, that becomes very real. And someone, it's not uncommon for us to find someone that is comfortable with a 10% loss, but not comfortable with a $100,000 loss, even though they're the exact same thing. But when you bring the dollars in, it becomes very real. Okay. So the output from this exercise, this acceptable range of outcomes exercise, shows us this risk number. In this case, a risk number of 32. So on a scale of 0 to 100, Bush is a risk number of 32, which if we think about this in terms of driving a car, a score of 0, and this looks like a speed sign, but a score of 0 would be like you're parked, right? The keys are out of the ignition. You're sitting in a portfolio of 100% cash, right? You're not taking any risk. On the other end, risk score of 100 would mean you're drinking and driving, weaving in and out of traffic at 90 miles an hour. In an investment portfolio, equivalent would be like a portfolio of small cap Israeli tech stocks. You're taking a bunch of risk. The range of outcomes is wide. Bush's risk number is 32, which is a little more conservative than a moderate risk of 50. So people understand. And then to put a bow on it, we're showing them within 6 months, and I'll get to the 6 months here in a second, what their potential range of outcomes would be over the course of 6 months based on the amount they have invested and their acceptable dollar loss over that period.
Yeah, and this is just great for us and our clients to go back to when the stuff starts to get weird, and we can kind of reference this exercise and talk about, how we felt during that time when they filled out the questionnaire versus now, what feels acceptable, if anything has changed, et cetera, et cetera.
So the next thing that we do is we have a asset allocation framework, right? So a actual portfolio that mirrors this risk score of 32, right? And the lower the number, the more conservative those asset allocations are, meaning they might own less in stock and more in bonds or more in gold. The higher this number, in general, the more aggressive, the riskier the portfolio is. So for every risk number that we produce by going through this exercise, the output, this risk number, allows us to map a portfolio that reflects this range of outcomes and this risk number. Okay, so I've said time and again, good investing is being open and candid about your capacity and ability to take on risks and building a portfolio that reflects that. That's over 80% or 90% of good investing. So a quick recap, the soft side, we want to understand past behaviors, where they're getting their news or information from, personal experiences that shape the way that we view money. And then we're using a very progressive, easy to understand way to conceptualize and bring risk in a more digestible form, an easy to understand form.
Yeah, and in addition to the risk questionnaire, the financial planning side, of course, ties into how a portfolio is built because they really go hand in hand. So we put an emphasis on understanding our clients on the personal finance side and also the behavioral side, and ensuring that everything makes sense for their individual situation.
Yeah, so once we identify the way they feel about risk and build the portfolio around that, the next part is looking at how they're actually invested and coming up with a plan to get to this risk number. And more times than not, many new clients are invested way more aggressively than they set out to, or they don't understand how much risk they're actually taking. And unfortunately, you can get away with that in an up market. So from 2010 to 2021, really, it wasn't really a thing. That didn't cost you. It actually might have helped you. But in a year like 2022, a lot of people got crushed because they didn't understand how much risk they were taking. So oftentimes we have to dial back people's portfolio to jive with how they actually feel about risk. Okay. So the other thing that I'll say, and then I'll talk about how we keep people on the rails, but back to my opening comments. So this is the portfolio construction process. And this is really the first meeting that we have with new clients, understanding their biases, understanding how they feel about risk, constructing the portfolio, coming up with a plan from taking their old portfolio and plugging it into the Pure Portfolios framework. But then they also want to understand, we also want to communicate how we make portfolio changes going forward. And I can tell you what it's not. That process is not me walking in as the chief investment officer and saying, team, I think emerging markets are going to do great this month. Or, hey, I just read a research piece and I think I think Google stock is going to do well this week. Unfortunately, that's how most advisors and most investors invest. They take snips of information, usually out of context. Maybe they read a fear-mongering article or a TV show on the news, and they want to get more conservative, or their advisor tells them that some asset class is going to do well, and they want to buy more of it. I can say with 100% confidence, if you're making gut calls the last couple of years especially, you've probably had egg on your face because nothing has made sense. There's no playbook for a pandemic. There's no playbook for the highest inflation that we've seen in 40 years. There's no playbook for the most aggressive Fed tightening cycle we've seen in 40 years. Everybody was wrong. And if I was to come back to one catastrophic error that I've seen coming out of difficult markets, it's how to get back fully invested. Selling's easy. Taking risk off the table is easy because the pain stops, right? You feel better immediately. But where 99.9% of people get it wrong is when to exit the bunker and get reinvested. Okay. Now I've railed on this enough, but I can tell you that Pure Portfolios has an investment process to get more conservative. Like in 2022, we were max underweight equities across the board. So within every investment objective, we were max underweight equities across the board. All right. Where we've really added value is despite all the negative headlines, despite Wall Street being the most bearish that they have in 40 plus years, despite everyone from your neighbor to your social media friends telling you the world's ending, markets have shrugged all that off and off to, I think, the 12th best start going back to the early 30s or something. Okay. During that period of time, Pure has a process for adding back equities, adding back to risk. And again, it wasn't us pounding the table saying things are going to get better, or there's nothing to see here. There's still risks to be mindful of, which is why we were slow doing it. Starting in the fourth quarter of last year, we were adding to equities. And right now, we are overweight equities. Okay. And I don't have an opinion on what the market does next. We took our cues from the market. We've been adding risk and clients have benefited. So that's a lot of talking. The point is we have a process for getting more conservative if things are getting worse, and adding to risk, adding to equities as things are getting better, despite what people say. I'll shut up now. I'm done.
I was going to say, I don't think I have a lot to add to that. But I think it's one of those things that's comforting for clients to have that framework to fall back on because, like you said, nothing has made sense the last 3 years, and people who made gut decisions probably didn't fare too well.
So all of those things that we're talking about, the acceptable range of outcomes, unpacking your personal biases, the last in having a plan for overweighting and underweighting risk, depending on market conditions. So we do all that. And in the meantime, there's a reason why we write the blog and podcast and do videos and commentary. That's to get people to think better, to cut through a lot of the noise. There's a ton of noise out there. And I've spent a better part of my 20-year career building information filters and being able to spot what's important versus what's not important. Now, we're not always going to be right. There's certainly been no shortage of things that we've been wrong on. But if you look back at our blogs, it's been pretty consistent and pretty, I have to be careful of what I say because I don't want to self-promote. But if someone was paying attention to what we were writing in 2022 and what we've been saying the last couple months, it's probably helped you make better investment decisions. And I hope that's not a compliance thing. I said probably, but I've said it time and again, there's so much coming at us. You have to have a mechanism for separating the signal and the noise. And we try to give it to clients straight, cut through the BS, to educate them, to keep their emotions in check, having a framework for making decisions, leaning into empirical evidence. Much of what I say and what I write about is not my personal opinion. I'm just a student. I'm a lifelong learner, and I'm leaning into what's happened in the past. And history doesn't always repeat itself, but it often rhymes. And I've said this again, the reasons for every cycle are different, but human psychology is very predictable. And when people are so destitute and so hell-bent on what happens next, and they're convinced it has to get worse, to me, that's a friggin' green flag. That's something else has to happen. When everyone agrees something else happens, and lo and behold, again, markets have raced higher despite all the wall of pessimism. Markets climb the wall of worry. The market is designed to make as many people look as stupid as possible. So when the herd is saying one thing, I get very curious on the other end. That could be getting more conservative or getting more aggressive. Now, I'm not going to act on it. It's just one data point in a series of data points that we look at. But sentiment is huge in the digital age because markets are humans trading with other humans. I think that gets overlooked.
So whether you are a current client or just a listener out in cyberspace and you have questions about anything that we have talked about today, you can always reach out to us at insight@pureportfolios.com or check out the Pure Portfolios blog on pureportfolios.com. So thanks for listening to this episode of Blind Spots. We will see you in the next one.